Hello and welcome to the fifth episode of Meet is Capital. We will try to give you our perspective of emerging and frontier markets. And we try to do this on a quarterly basis. My name is Grapengiesser. I'm the CEO of Is Capital. And together with me here today, I have David Nicholls, who is a PM for our global emerging market strategy. So David, what happened during the quarter?
Yeah, sure. So third quarter was another incredibly exciting quarter for emerging markets, and of course, actually through most of it, the main narrative was the Fed rate cut expectations, which of course culminated in this bumper 50 basis points cut in September. But of course, that was completely overshadowed in the last week by this sort of shock announcement from the Chinese in terms of the sort of whatever it takes type approach to really boost the economy. And the impact on returns was really striking. And if you look at this slide, you can see the numbers. And just to remind, this is for Q3 only and year to date up to the end of Q3. China returned 24% in the quarter, driving emerging markets to return 9%, which is well above developed markets, which returned 6.5%. And this is actually the second quarter in a row where emerging markets have outperformed developed markets. I think it's also worth highlighting the continued strength in India, which is the second largest country in emerging markets, as well as quite a few of the Asian countries like Indonesia, that are really obvious beneficiaries of the rate cuts, both in the US, but also domestically, which is something we'll discuss a bit more. But I think, no, very much the main narrative is China. And Jacob, you're based in China, you're there at the moment. I mean, could you start by sort of going through what exactly has happened already in China over the last few weeks?
Yeah, so last week was a holiday week. We had the so-called Golden Week. And before the Golden Week, the supply side measures were being announced by the People's Bank of China. So we had a number of, let's say, ways to release liquidity into the system. We had a 50 bips cut on the reserve requirement ratio. This might release 1 trillion renminbi or $140 billion. We had a 20 bips policy rate cut. It's quite small, right? But this is how they do things in China. They do it small and incremental. We had a 50 bips mortgage rate cut. And we had some more stimulus measures on the real estate side. And the last was a bit peculiar one, and it's a 800 billion renminbi support to the equity market. It effectively means that insurance companies can take their existing holdings and lever them to buy even more shares on the market. Of course, if a stock is yielding you 10% and you can borrow at 3%, you would be inclined to borrow at 3% and then buy more shares, right? So in theory, this all gives a 40 bips incremental increase to GDP. The problem is that these are supply side measures. This is releasing liquidity, but I mean, there needs to be demand for that liquidity. There needs to be demand for more loans. Otherwise, it's all in vain. It doesn't really help the economy. So what the market was really waiting for was the demand side measures. And we had on Tuesday morning, the National Development and Reform Council presenting a number of demand side proposals. They were weaker than the market expected, and hence this is why we're seeing today actually the market being quite weak. The Asian markets were strong yesterday because they were people were on holiday, right? The markets were closed. But then we are seeing the weakness in the market today. So I think we'll see, and I will probably get back to a longer discussion on what's next for the Chinese market.
Okay, thanks. And what then have been the market implications for these sort of shocking announcements, I guess?
Yeah, so the market this rally is 28%, right? So the market was up a bit more than 30%, then it came off a bit, as I said. So the market is up 28%. I mean, that's obviously a strong rally. It's been a pretty sharp rally, as you can see here on the chart. Having said that, the market is still down 41% since the peak in 2021. So, you can see it in two ways. Either it's up 28%, which is great, or it's still down 41%. And overall, I would say that Chinese holdings are cheap. If we take Alibaba as an example, and we look at versus its own history, this is just one of the big stocks, especially owned by American investors. So the historical average for the past 5 years was 9.9 EV/EBITDA. Now it's trading at 4.3 times EBITDA. So it's less than half its own historical average, right? If you look on the P ratio, it's trading at P 11.6, but that's including a lot of cash. If you would adjust it for cash, it's going to be around a P of 9. So valuations in most cases still look reasonable. In some cases, stocks have been going up a lot, and hence, valuations have also became not excessive, but no longer as cheap as they used to be.
Well, thanks for that. Where do we go from here then? I guess that's the question everyone's asking.
So I had a lot of discussions on this, and I spent the whole morning with the team here and some let's say inform people about the market. So first of all, it's pretty clear that to reach the 5% goal, you need to stimulate the economy more, and you need demand side measures. You need fiscal measures. Those could be in the range of 2 to 8% of GDP. I don't think you're going to do 8%. That's massive, but probably 2-3% is reasonable to expect. When will these announcements come? Yeah, so you should be aware that the economy in China is not doing great. Youth unemployment is high. People have been losing their jobs, etc. And I think people are expecting that the government fix the situation, if I just put it that way. And clearly the situation hasn't been fixed. As I said, these are supply side measures. You can go to the bank and borrow more easily now, but if your business is not doing well, you're not inclined to borrow more at the bank anyway, right? So we would expect more measures to come. On Saturday, the Minister of Finance will hold a press conference. That's probably going to be key. But personally, I would expect some smaller measures now until the US election, which is only a month away, and then post-US elections, more stimulus measures or larger stimulus measures, and money being sort of pumped into the economy. They can be of various kinds. It can be anything from giving vouchers or coupons to people to buy a new iPhone. If you go to Shenzhen now, you get a 2,000 renminbi voucher to buy a new iPhone. That's $300 voucher. That's pretty good. I mean, I would do that. I told my wife she should do it. So you have these kind of things little by little happening, but again, we need to see more of that, and we're going to most likely see more of it. The question is if we're going to see it now or after the US election. If we turn to the positioning, which I think is also key, if you look on globally versus their own history for mutual funds, they are at the 0th percentile. So they are at a record low in terms of allocations to China. And I think whatever data you look at, you can see that positioning to China is very, very light. And then even though there has been a 28% rally, I still think that most investors are either not positioned at all in China or very lightly positioned in China. Hence, once we have seen more measures coming out, I would not be surprised to see much larger inflows to the Chinese market overall.
Okay, thanks. Yeah, something to look forward to. How have we then been positioning or dealing with this sort of China volatility?
Yeah, so we are a country neutral fund. That might sound a little bit odd that, sometimes you would think that, if you have a strong belief in a certain country, it should do better than another one. But I think currently it's hard, Is India going to perform? Is China going to perform? Our conclusion is that there probably go good companies in most markets. And hence, by doing this, we firstly decrease the risks actually. But then when there is a strong market upturn like this in China, we would position in a neutral way. I think we actually added a little bit of alpha in China with the stock selection process that we have for China during this rally. And secondly, we repositioned quite a bit in the portfolio. For example, we bought shares of Ping An. It's a big insurance company that benefit of some of the policies I earlier mentioned. It's up 40% since we bought it. We had another stock called Meituan. It was up 150% year to date. We had a massive gain, and we then sold half the position to lock in those profits. So we've also been actively trading. I don't think we're necessarily a very trading-driven fund, but when we see these big movements and we see opportunities, we of course take them and make sure that we either lock in some alpha or try to make some more alpha.
Okay, thanks. And then finally on China, we relaunched our China A shares fund as an all China fund in August. Could you tell us a bit more about that and how it's been performing?
Yes, so from August 1st was inception date of our new China fund. We had a China A share fund, but we changed that to a China fund, which means that it can buy A shares, it can buy shares in Hong Kong or in the US. We just want to make the best possible return. Since the launch, the fund is up 30%, so it's been doing well. But I think what is even more important is that this is both a defensive and offensive portfolio. Of course, in August, we didn't know about any stimulus for Chinese economy, so we were positioned in quite a defensive way. We bought names like China Education, it's just 15% growth, private universities, P5, 10% dividend yield. Very kind of simple stories that were not so much dependent on the economy overall. We have slightly repositioned that now because we have a slightly more positive view in the economy. But if you look on the performance in August, which was effectively flat, I think we were the second best China fund. If you look on the performance in September, when the market was rallying, well, we were also the second best. So net, since we launched, I think we're now in the second position. At least we're one of the top funds, and we generated significant alpha since we launched. And I'm really happy with that because I think that was the point about that fund, that if you want to have a good exposure to China, both in a modest scenario but also in a positive scenario, this should be one of the vehicles that you can use to get that.
Okay, thanks very much. And another question that investors have been asking us is how this sort of China will affect the rest of emerging frontier markets. And I think our view is that it's generally obviously positive. It's particularly positive for sentiment, as Jacob showed with the sort of positioning, but it also increases the chances of a sort of a soft landing globally, right? And a sort of really depressed China would definitely be one of the risks to this. But I think in order to really see a sort of pick up and direct impact, you need to see the economy starting to turn around, as Jacob said, and we really haven't seen those sort of fiscal measures that would do that yet, but obviously we're hopeful. I think what's actually probably more important in terms of looking at the broader EM and FM universe is obviously the rate environment, right? And this is something we've been discussing for years and probably won't stop. And it really has had a profound impact, and you can see that probably most obviously in the currencies. And this is the Bloomberg Asia Dollar Index. You've seen a really strong pickup in the Asian currency basket since we've had these sort of shifting Fed rate expectations, for example, and that means that not only the Fed's obviously cutting, which is great, but also domestically central banks are able to start cutting their rates as well. If we so for example in September we saw Indonesia, Philippines, Mexico start to cut rates, and that has really profound implications for obviously the economies, but also actually the companies we invest in, particularly the growthier companies that do have debt in order to finance their growth. And we should also mention India, of course. It had another good quarter, as I mentioned. It actually at one point it even overtook China as the largest market in emerging markets, both around 22%. Obviously that's changed now, but this was such a big change from 2020 when India was only 8% of the benchmark and China was 40%. So it's a really, really massive drive for emerging markets now, and a country that we spend a lot of time on. And as we've mentioned, one of the major narratives is this domestic investor flow. We've had almost 30 billion of domestic flows this year to date, but actually in Q3, international investors jumped in as well. You know, they've typically been underweight India, a bit worried about valuations and things like that. But we saw 10 billion of inflows there as well. So India's really started to perform. And I think where India is different to most of the markets is a lot of these flows are active flows. So really finding these sort of future investor darlings, as we call it, you know, which is our approach in India, can be very fruitful. If we find the companies that all these mutual funds in India want to buy, you can generate alpha, and that was really borne out in Q3. For example, in our Global Emerging Markets Fund, where our Indian holdings returned 25% compared to only 7% return for the benchmark. So yeah, that was 3.5 percentage points of alpha just from India, for example. So yeah, we really like India going forward, and think it's a very sort of an excellent place for sort of really bottom up fundamental stock picking, which is what we love to do. But yeah, Jacob, maybe you could speak a bit about frontier markets.
Yeah, so some of this excitement we saw in emerging markets might not all investors like that, right? This crazy volatility. So if you prefer to sleep well at night and just get your 15% earnings growth and still decent performance, but uncorrelated returns to emerging and developed markets, I think the frontier markets is the answer. As an asset class, it's returned 4.5% during the quarter, so that's still okay. I think the big one was Vietnam. So in Vietnam, you have gone from a system of so-called pre-funding, that you need to wire money before you buy shares, to a normal T+2 settlement system, which means that effectively you pay once you have bought the shares. This is how all developed and most emerging markets also work. So I think this was very positive for that market, and with a few more steps to go, I think Vietnam could possibly even become an emerging market. So entering the emerging markets index by 2026. So overall, not a super eventful, but a relatively decent market for decent quarter for frontier markets.
Yeah, sure. And as usual, another busy quarter for traveling. You know, I think we were on the ground visiting companies in Istanbul, Shenzhen, Seoul, Mumbai, Jakarta, Abu Dhabi, among other places, I would say. But yeah, what was sort of, which trip stood out to you as particularly memorable, Jacob?
Yeah, I travel all the time. I think I travel a bit too much, but I remember one of the meetings I was visiting Burjeel Holdings. It's a Abu Dhabi-based healthcare provider, or they're operating hospitals, and I sat down with the chairman, and he explained to me the vision for the company, and effectively they were at only 10% of the size where he wanted the company to be, and that they had even acquired the land plot, you know, for those future hospitals, so that they can grow the capacity by 10 times. We had another holding in another fund many years ago, and the main owner told me the same thing, that, you know, Jacob, I have only one hospital now, but I will have 10. And of course, at the time, I was a bit skeptical and didn't really believe him. But looking back in history, 7 years later, they actually have those 10 hospitals. So I was making a bit of comparisons, and no, it might not be easy to get there, but I think this is the type of growth you can talk about in emerging and frontier markets. In developed markets, a healthcare provider typically won't increase the amount of hospitals they have by 10 times, right? Those hospitals are already built probably by someone else. So this was quite interesting to me, and I think it's a good example of how we also see these markets. It's a bit visionary. You need to think long term, but if you can do that, you can also get fantastic returns, not maybe 1 year, but over 3, 5, 10-year time horizons.
Yeah, indeed. And on the sustainability side, we published our H1 impact report, which really hope is interesting to a lot of people, actually. And essentially what we're doing is trying to use data to show the sustainability outcomes of our investment. You know, we have alpha to show how we've done on the financial side. It makes sense we have something similar on the sustainability side, and we show how we're using these metrics to measure performance. And as an example, right, so because of our sort of small and mid cap tilt, we're actually previously worse than the index in board gender diversity, for example. Only 14% of the board members of our portfolio companies in H2 2023 were female. But actually, after the AGM season and now looking at the end of H1, it's now 19%. And that's actually better than the benchmark, which is only 18%. So it's really nice to see these sort of metrics tracking up. And that's obviously partly due to engagement from investors like us and pressure on them. So yeah, I definitely recommend giving that a look. But I think now we've come to the end, Jacob. What is our sort of broader outlook going forward for emerging and frontier markets?
Yeah, so I tend to be quite optimistic, but I hope I have reasons to be that for emerging and frontier markets. So firstly, we are seeing rate cuts in the US, right? With that, quite likely a somewhat more soft dollar. That's good news for emerging markets. Historically, you had emerging markets borrowing in dollars, and it was easy for them to pay back the money. But I think this historical sort of correlation between a weaker dollar, strong emerging markets, it lingers. It's still there. So that's good news. Secondly, elections in the US. A Harris win would be a major positive for China and hence for emerging markets. But even a Trump win might be a good thing, because then at least it's sort of out of the way, and China on the back of a Trump win would very likely stimulate their own economy massively. So even though we have trade tariffs that are negative, the stimulus might actually outweigh that, and the stock market might perform on the back of it. So I would, position now in terms of getting the exposure, not post factum. But China, of course, overall is a factor, right? And I think if China performs and you're seeing the stimulus measures, I mean, that's also sort of the elephant in the room, right? That's why people don't like emerging markets, because they don't like China. But finally, and a factor that should not be ignored, is the positioning. I was showing some of the previous positioning on China, but the same is true for emerging markets. Positioning is very light, and hence, any good news can have a bit of an outsized impact on the market. So I think with that, David, we'll wrap it up. We thank you for your time and listening. And let's see in a quarter's time what happened to emerging markets in China. It will be quite intriguing to follow. Thank you.
Thank you very much.